The reason crypto has continued to have lingering weakness is that market makers who play a critical role in crypto have weakened balance sheets from that liquidation event on October 10th. Equities had a disappointing day. Nvidia reported good results, and stocks initially rallied 2% at the open, but at 10:36 a.m., markets peaked and staged a pretty sizable decline with a 3.5% decline into the close. And that took us down 1.6 for the day.
The recent market meltdown was not merely a random fluctuation, it was a calculated response to a convergence of political instability and structural fragility. We observed a precise correlation where equities turned downward mere minutes after political friction regarding seditious behavior surfaced on social media at 10:21 in the morning. Simultaneously, the market began pricing in the reputational risks associated with the mandated release of the Epstein files, creating palpable nervousness regarding billionaire liquidity. However, the primary leading indicator remains the digital asset sector. Bitcoin peaked and weakened hours before the S&P 500, continuing a trend where crypto acts as the canary in the coal mine. This weakness stems from a massive liquidity shock that occurred on October 10th, the largest in crypto history, caused by an auto-deleveraging pricing error. This event has left significant holes in balance sheets, setting the stage for a complex correction.
Subscribe to Daily Bitcoin Trends for expert insights, real-time market updates, and proven crypto strategies. No hype, just smart analysis to help you make better decisions in crypto.
First, I think one factor behind the meltdown was that there were some tweets that created a little bit of outrage on social media. And it was President Trump responding to some Democratic veterans suggesting that they can ignore orders from Congress. And that first tweet was at 9:17 a.m. The second one came at 10:21 a.m. He said, seditious behavior punishable by death. Now, notice the timestamp. That's 10:21, and the market turned down just a few minutes later. That tweet led to Democratic Congress members and leaders protesting the death threats against Democratic members. Now, the second thing that I think did contribute to the decline is the release of the Epstein files. So President Trump signed the Epstein Files Transparency Act into law and now has ordered these files to be released. There's going to be a lot of people in those files. In fact, for instance, here's someone pointing out that it could even embarrass many donors, billionaire donors. So you can imagine there might be investors who are just nervous who's going to be on that list, and it's revealed. Does it do something to markets? I think that contributed to some of the nervousness today. The third factor is crypto. Bitcoin has been selling off recently and generally has led the equities, but you can see at the open, Bitcoin peaked and began to weaken at 9:30, and the S&P followed basically an hour later. This has been the case for some time. It's something I've pointed out, that Bitcoin has been leading the S&P. For instance, Bitcoin peaked on October 10th. That's right before we had that liquidity shock, which ended up being the biggest liquidity shock in the history of crypto, wiping out more than 2 million accounts. And Bitcoin's been falling since. But as you can see here, this has led to the S&P spider peaking on October 29th. And, it's something I was interviewed on CNBC today, and I mentioned that since October 10th, there was this feature called ADL that caused a significant amount of liquidations, and it was really due to a pricing error. But that pricing error has not has created significant holes in the balance sheet. In other words, the reason crypto has continued to have lingering weakness is that market makers who play a critical role in crypto have weakened balance sheets from that liquidation event on October 10th. Now, market makers are essential to crypto liquidity. They're essentially acting like central banks because they provide liquidity. And their pulling back is the equivalent of QT for crypto. So you can imagine crypto is suffering from tightening conditions along with a hawkish Fed. Now, in 2022, when a similar event happened because of FTX, it took 6 to 8 weeks to recapitalize those market makers and for market function to recover. So we're about 6 weeks into this process.
Bear markets for Bitcoin is that recognizing that they tend to start in Q4 of the post-halving year. Okay? So there is in fact a chance that this time is not different, despite us all wanting it to be. Who doesn't want Bitcoin to go to 200K, right? I would love it if it could do that, but at the same time, we have to be aware that we could be in a bear market, right? And you know, there's definitely like evidence mounting to really start to suggest that, and there has been for a while. We've talked about some of them already. One of them being like the ROI from the low, and looking at this cycle compared to you know, the last 2 cycles. And if you look at this top right here, it kind of aligns with the last 2 tops in terms of time. And so because of that, we have to, it would be prudent to at least say, hey, that could be it. For a long time, I've said I think the top will either be in October or December, not November. November is what we had last time, and usually Bitcoin doesn't repeat itself twice in a row. So October or December. Right now, it's certainly leaning towards October. I would say the odds of the top already being in October are at least 60 to 70% likely. Yes, there's still maybe a 30% chance that it's not. But if we were to get a second weekly close below the 50-week moving average, then the odds would probably go up to over 80% that the top is in. You know, is there a chance that you know, Bitcoin could get some type of rally back up and sweep the high on some type of like massive bearish divergence? Yeah, like it's possible. If you look at like the RSI, I mean, all of these all these highs have been lower highs, and Bitcoin's been able to go into higher highs despite the RSI showing clear weakness for a while. The problem is that the weekly RSI is starting to break down, and normally when the weekly RSI breaks down from like a level that it's been holding for a while, usually it in fact means that the cycle is in fact over.
To understand the persistence of this downturn, we must look at market structure. Market makers in the crypto space function essentially as central banks. They provide the necessary liquidity for function. Following the October 10th liquidation event, these entities have pulled back to recapitalize, creating an environment equivalent to quantitative tightening for crypto. This internal tightening is coinciding with a hawkish Federal Reserve, exacerbating the downturn. Critically, we are likely witnessing a non-euphoric top. Unlike the peaks of 2017 or 2021, this cycle lacks retail mania. The data supports this. The ISM Purchasing Managers Index is significantly lower than in previous cycle peaks, indicating that the Main Street economy lacks the excess liquidity required to fuel a retail frenzy. We are seeing a market structure that mirrors 2019, where Bitcoin rallied but ultimately decoupled from a struggling altcoin market due to a lack of broad economic strength.
So when we think about it, we have to think about, all right, well, this seems like a bear market in a lot of different ways for Bitcoin. And that doesn't mean that your altcoin can't go put in a new all-time high. Some alts are already putting in new all-time highs. More altcoins could continue to put in new all-time highs. I'm not talking about your alt. I would, of course, never do that. What I'm saying is that for Bitcoin, it seems like the tides have started to turn here, and that we're kind of in this downturn after a non-euphoric peak, right? It's a non-euphoric peak, which is very different from the 2013 peak, the 2017 peak, and the 2021 peak. So in one sense, this time is not different in the fact that it seems like the top's occurring at the same time that it always does, and that's Q4 of the post-halving year. In another way, it's entirely different because when you look at the social interest in crypto, this is a non-euphoric peak. This is not like 2021, and it's not like 2017 in the sense that it's not accompanied by euphoria. And so why is that? Like, why is there no euphoria? What's going on? Why did the alt season never happen that everyone kept calling for? Well, one of the things we looked at recently was the ISM Purchasing Managers Index. And that kind of shows you, it's the manufacturing, shows you kind of this Main Street idea of like, look, in these prior peaks, the PMI was way up here. But this time, it's way down here. Main Street is struggling, right? They don't have this excess liquidity to go buy crypto with like they did in the last 3 peaks. In fact, it looks a lot more like, again, what happened in 2019, right? It looks a lot more like what happened in 2019, where Bitcoin went up, but it left the altcoin market behind. And so you could argue that we've entered into this type of downturn right here, right? That type of downturn. And if that is the case, then we also have to include that as well in our bear market projections. Now, in that case, Bitcoin dropped about 50%, even if you exclude the pandemic crash, right? So let's just exclude that for a moment. And let's just pretend like Bitcoin didn't go through that right there, okay? It was about a 50% drop. The reason why a 50% drop from the high does seem like an eventual outcome is because you can also see that in all these prior midterm years, or sometimes in other years, but Bitcoin tends to check in with its 200-week moving average. Last cycle, it even went below it. And so when you look at the 200-week moving average, it's currently at around 55 to 56K. Now, by the time you're looking at like mid next year, it's going to be closer to 60 to 70K. You know, if you like look at where it is on that line, you can see how it'll be between, say, 60 to 70K. I need to sneeze. I'm not going to edit it out. But that's what I'm looking at. Because when 2019, that's exactly the type of drop it got. Exactly the type of drop it got. In fact, if you take a bar pattern on this 2019 top, I can do better than that. And you line that up, right? If you look at that and you just kind of come over here, you can kind of see what I'm talking about, right? Like, you know, it's possible for Bitcoin to bounce back up in here, maybe even go back to 100K a couple of times, but eventually it seems like, you know, by May or something, it's going to find itself between 60 and 70K. Now, if you ignore the 2019 bear, or if you want to include the pandemic drop, you could argue that Bitcoin did in fact drop about 70%. I am under the assumption right now, and maybe I'll change my mind, but I'm under the assumption right now that we are in this type of a bear market. And that the reason is because we are coming off a non-euphoric top. You can have bear markets off non-euphoric tops, just like 2019 showed us. But if it is a bear market off of a non-euphoric top, then the nature of the bear market might be very different than a bear market coming from a euphoric top. If it is the same, and it doesn't matter whether it's met on euphoria or not, if it is the same, then you still want to look at a chart like this, which shows the ROI of Bitcoin as measured from the peak.
The probabilities now suggest that the cycle top is likely in, with a 60 to 70% chance that October marked the high watermark. If we confirm a second weekly close below the 50-week moving average, that probability rises to over 80%. Investors must prepare for a mean reversion. Historical data indicates that in these non-euphoric bear markets, Bitcoin tends to revisit its 200-week moving average. By the middle of next year, that moving average will likely sit between $60,000 and $70,000. While a relief rally to sweep the highs is statistically possible, the breakdown in the weekly relative strength index suggests the momentum has shifted. We are entering a period of capital preservation, where the market digests the 50% drawdown typical of this specific cycle structure. Strategy now requires patience, as we wait for market makers to fully recapitalize.